हाय इन्वेस्टर्स, वेलकम टू SOIC। तो आज के इस इंटरव्यू में हम लोगों ने क्या करा है, वी हैव होस्टेड वन ऑफ द वेटरन इन्वेस्टर्स एंड ही इज़ अ वेरी गुड फ्रेंड ऑफ माइन ऑल्सो। साथ साथ जब हम इन इन्वेस्टर की जर्नी देखेंगे तो यू विल अंडरस्टैंड कि हाउ लाइक करेंटली जैसे अगर वो कॉर्पोरेट वर्ल्ड में काम करते हैं तो कैसे उन्होंने वेल्थ क्रिएशन की जर्नी स्टार्ट करी। देन वाई इज़ इट इम्पॉर्टेंट टू सी मार्केट साइकिल्स, क्योंकि बहुत सारे इन्वेस्टर्स ने 2020 के बाद इन्वेस्टिंग स्टार्ट करी होगी। तो इट इज़ वेरी इंपॉर्टेंट टू स्पेंड टाइम इन द मार्केट्स रैदर देन टाइमिंग द मार्केट। तो इनकी जर्नी से आपको पता लगेगा कि वाई इज़ इट सो इम्पॉर्टेंट टू स्पेंड टाइम इन द मार्केट। एंड पूरी थ्रू आउट द जर्नी में यू विल सी देयर आर मल्टीपल इवेंट्स विच हैव हैपेंड इन द मार्केट, जिससे मार्केट की साइकिल्स चेंज हुई। तो चेंजिंग साइकिल्स के साथ साथ कैसे सेक्टर्स चेंज होते हैं, थीम्स चेंज होती है, एंड अपना थॉट प्रोसेस आपको कैसे मेंटेन करना चाहिए अबाउट इन्वेस्टिंग इन टू डिफरेंट स्टॉक्स एंड द एबिलिटी टू होल्ड स्टॉक्स। सो इन दिस इंटायर पॉडकास्ट व्हाट वी विल डू इज़ दैट हम लोग जो विनय अम्बेडकर जी हैं उनकी जर्नी से सीखेंगे। उनका इंट्रो हम बस शॉर्टली स्टार्ट करेंगे, बट एज अ रिटेल इन्वेस्टर जिसने जर्नी रिसेंटली स्टार्ट करी है, दिस इंटरव्यू इज़ अ मस्ट वॉच फॉर यू, बिकॉज दिस विल हेल्प यू इन टर्म्स ऑफ अचीविंग योर ओन गोल्स एज वेल। एंड साथ साथ आपको ये भी सीखने को मिलेगा कि एक इन्वेस्टिंग की जो जर्नी होती है लास्ट 10-15 ईयर्स की, वो कैसे तय की जाती है। विद दिस लेट्स स्टार्ट। Hi and welcome to this session on yin and yang of investing. So something about Vinay sir. So I'll just give you one of his qualities because I've been interacting with him for last 3 years almost now. He's too humble to admit that he's a really good investor, and his humbleness is something which is one of his traits which I really like about him. Apart from that, he's a mechanical engineer and he has an MBA in finance by qualification. He's a banker since 2021 and he has worked at ICICI in various roles. Currently he handles the SME credit risk department at a local bank in Dubai by the name of RAK Bank, and he's been investing since 2011 2012. I think he's also worked as a credit analyst, and he keeps on saying ki, I'm a credit analyst by the day and I'm an equity analyst by the night, because he's working in the day at a bank and during the night he's basically studying about all the equity investing. So I'm there on a couple of WhatsApp groups with him. So during the night time he's extremely active about equity. So over to you, Vinay sir.
Thank you, Ishmoit, for arranging this. This is really. I mean, I don't have words. On a Sunday afternoon, we have 750 participants here. Welcome, my dear friends. I hope you will find this session useful, and I hope I'll be able to do some justice to it. I mean, I like Ishmoit said that I am a 22, 23-year-old banker. I started my professional career in 6 with ICICI Bank. And I'm an investor in a more structured way for about 11, 12 years. So you can see that I'm not even an adult in my investing journey. So there's a long way to go. What I have generally seen is good people, good analysts, good managers, good coaches like Ishmohit. They have a very, very good and structured program on how to go about investing. And it's really, really useful. Many of my friends have benefited, and I'm sure all of you also would have. What I wanted to try and contribute from my side is my journey, and what mental struggles does an investor usually go through. So the last 10, 12 years, I've seen a few ups and downs and have seen myself change in this period. So when I was thinking of how do I present it, the concept of yin and yang resonated immensely. For example, we have contradictions as investors within ourselves, and how the concept of yin and yang says that how seemingly opposites they coexist in harmony. So sometimes some struggles that we go through is do we need to have a diversified portfolio versus a concentrated portfolio? At different times we will have these questions come. While we focus on individual stocks, what matters is the portfolio performance. So this is another type of whether we book profits, book losses, whether we hold through ups and downs. These are constant struggles that we go through. Whether investing is a game of skill or what is the role of luck in this. While we want the upside, we fear the downside. We want to try and make money now, but also we want to try and invest for many years. These are all contradictions that lie within us. The urgency of action versus the patience to hold on. There is a phrase which you might have heard: strong opinions loosely held. So be flexible. Accept that you may be wrong while believing that you are taking the right decision when you buy or sell. And the worst or the best example of a yin and yang is that over my investing career, I have seen that buying works best when it feels the worst in the gut. So these are things that we have to live through as investors. And I thought I will elaborate a little bit more on these aspects. Upfront, some disclaimers. These are not the normal disclaimers, like stock recommendation should not be seen and it's only for educational purposes. All that is there, of course, because if I take stock examples and I try and talk about positives and negatives, please don't take them as recommendations for or against. What I'm trying to say is, my way is not the highway. This is the path that I have chosen, and my path has changed, and it is not necessarily the right way. So hopefully you will be able to identify with some of the aspects, and you may also not agree with some of the points, so which is perfectly fine. What I'm trying to present is how my thought process has changed for these years. This is a buffet, like they say, there are many ways to heaven. So I've probably been eating something else. Now I'm eating something else. And I may go back to my earlier diet as well. So, the idea is to be flexible in this market. If I try and if I end up, inadvertently doing some comparisons, please, that is not intentional. The only person I compare myself with is my past self. And many times you will see me refer to the future Vinay Ambekar, let him deal with the problem. So, it's not about me versus my friend, because sometimes it has so happened that my friends are doing what I used to do, but now I'm doing something different. But it doesn't mean that I will not go back and change my path. Like I said, that cute cartoon reflects that there is no comparison. Nobody is better or worse. I'm awesome. You're also awesome. Right? So that's the disclaimer that yeah, it was in early 2000 that I started my so-called investor journey, but I would call it the age of ignorance. It was the telecom media technology IPO craze. I was doing my MBA at that time, and my father used to make me run from Jamnalal Bajaj to the ICICI Bank branch behind the college in that Bay examination. Pick up some IPO forms, take it to him in the evening. He used to fill it up, and the next day I used to run and deposit them. And the craze was such that within a week, 2 weeks, it used to be 50, 100% up. Just because there is a .com or a technology name associated with the company. How it benefited me was, I had some meager savings during my 1 year stint as a graduate engineer trainee in Reliance Industries, and that money also happened to get quote unquote invested, and that kind of paid for my MBA course. So I owe a lot to the equity market right from the beginning. 2001 is when I started my professional career with ICICI, but it was the age of naivety. As usually, a new professional, a new salaried employee will be, the focus was on professional development. I let the entire bull run pass by me. 2003 or 4, it started right up to 2007 or 8. There was no attention to stock markets. Typical investments were in property, fixed deposits. Thankfully, I had some SIPs started at that time, and which increased well. So a typical journey of a new salaried. 2006 is when I came to Dubai and I got in touch with a couple of friends, and I started exploring doing individual equity investing. But it was haphazard completely. So you listen to some TV analyst on TV or fund manager on TV, like for example, SP Tulsian is the name comes to mind. CNBC Awaz, in the evening 8:30, used to come and give out a couple of stock names, and then you do some quick screener. Also wasn't there at that time. Started in 2009, if I'm not mistaken. And you just kind of do some new number crunching, and next day you go and buy. A friend tells something that he has heard from somewhere, you do some like PE types of quick analysis, and then you go and buy. And a typical mistake that usually happens after a bull market is that I ended up buying fallen angels, as they are called. So because the stock price of say companies like Aban Offshore or Punj Lloyd, these kind of infrastructure stocks had fallen a lot, so you go and buy them. I think at the end of that period, I'm sure means I maybe FDs would have done better than how my stock performed. Thankfully, one point is that I was still aware. Being a banker, I was aware of what was happening in macros, the global financial crisis. I kept track of what the US was doing. The QE equivalent at that time was TARP, Trouble Asset Relief Program, where 700 billion was infused and another 800 billion was infused for a period of a year. So I used to keep track of that, look at stock markets, your stock market, then go to sleep, and then look at our Indian stock markets. So there was kind of, like I said, haphazard engagement with it. 2010, luckily, I came in touch with Basant Mahesh. And that was like an aha moment for me. And I really, it was a transformative period for me at that time. Where Basant Maheshwari taught me how to think about equity investing in a 10x 10y framework, 10 times in 10 years, how to look at companies in that way, how compounding works. So that really hit me, and I said, this is excellent. And in spite of having not done very well in the previous avatar, I did not let it dissuade me that something good can happen out of this. I'd like to take a moment here because many of us would be young investors. I want to just talk about compound interest formula. We all know that it says amount is equal to principal into 1 plus rate of interest raised to number of years. So typically we would focus on R, but actually rate of interest or rate of return is not in our hand. The biggest influencer on compounding is N because it is exponential. It is raised to. So the effect is multiplied. But N is, is far away, like 3 years, 5 years, 10 years. So it's very difficult to imagine the impact of N today. So thankfully, I was very early to realize how important P is in this formula, because P is something that is in our control today. How much amount I can invest. So rather than investing my savings, I used to actually spend less. Okay, I used to have a target that I must invest so much, and then all my expenses used to be managed from the balance. So in that time, I would have read 100 books. You talk of any book, so I'll tell the Rich Dad Poor Dad. I think is a must read for all of us. That changed my outlook on how I looked at assets versus liabilities. Then the second book, a very good book, which is commonly recommended, it's a good book, is One Up on Wall Street. Then you have a very influential book on me was Common Stocks, Uncommon Profits by Phil Fisher. That laid out a very, very good framework on how to think about quality. So that was the age of learning, where almost for a full year I was just reading and learning. I did not do any investment at that time. Moving forward, a bit of behavioral finance also I was exposed to. There's a very good essay by Charlie Munger, which is a must read from behavioral finance perspective. Parag Parikh's book is very good on that. Some books like Poor Charlie's Almanac or The Intelligent Investor, I found very heavy when I was starting off. So I kept it for much later. 2012-13, is when I then decided that I need to start investing in a structured way. So I had 60 plus stocks. Some of them were good, so I held on, and the rest of them I just exited, sold them. That was the time of TED, the equity test, Basant Maheshwari, value picker. It was low PE investing. For example, Page at 25 times was considered expensive. It was also one more point I would like to tell you that India is not delinked from global. How much ever we may want to think that way, in at least in my history of experience, it is not that way. India may not do may do slightly better or worse, but if the global environment is not good, it is very difficult for India to do well. Okay, so this is something that I have seen work out many number of times. So even during this 12-13, if somebody remembers that there was this crisis in Europe, which was called it was a debt crisis. There were PIGS countries: Portugal, Ireland, Greece, and Spain. So they were going through a lot of problems coming out of the financial crisis, but it was managed well. So that was a period where things were starting to turn around. The US was coming out of the effects of the financial crisis. There was a taper tantrum in between where they started tightening too early, but then they pulled back the Fed. So it was a rising tide, and mine also went up. I had not much idea about quality, but what I did was, I subscribed to a few subscription services because being very new to investing, while I knew broadly business analysis, management analysis, financial analysis, it was difficult. I knew that hanky panky was happening. So there were books that were getting cooked. You could not rely on financials almost always. So, and I was not a forensic analysis. So I wanted somebody to filter out at least these basic aspects. But at the same time, I had a passion to do it myself. So which is when I subscribed to a few, and then there were idea generators. In that time also, because I realized the importance of principle, so I was very, very keen to put as much amount to work as possible. So all my salary savings were going into that. When I saw things were working, then I stopped my SIPs, and that money started going into direct equity. After some time, I pulled out my accumulated mutual fund corpus and invested it into direct equity. Blasphemy, I broke FDs and put it into equity. And lastly, because UAE is linked to dollar, dirham is linked to dollar, so we are a low interest economy. So I was able to get credit card debt or personal loans at low interest rate. I took them and I put that money to work in equity, but always ensuring that the repayment of those loans was very, very comfortably managed through my salary. So I was not dependent on the stock market for repaying those loans. That is something that we should always. I'm not saying this is right or wrong. I'm just saying that this is how I try to increase the principle that I could put to work. Okay. Moving on. 2014 was a bumper year. Again, it was globally also. The tide lifted my boat as well. Everything did well. And you would remember that 2013 mid was when Narendra Modi was announced as the Prime Minister candidate. And from then, actually, there was a swing in the Indian markets as well. Everything did well. In fact, ironically, public sector bank rally, PSU rally was something that happened at that time also, in the hope that the new government will be able to clean up these organizations. But history showed that that did not sustain. So maybe this time is different like this. 2015-16 was when the tide started going out. Like Warren Buffett says usually, that when it goes out, we know who is swimming naked. Thankfully, I had my underwear on. The high PE stocks did not fall too much, but they underperformed because a lot of attention had got shifted to cyclicals. So chemicals, if you remember, China had started putting constraints on their environmental pollution levels. So in India, chemical story started at that time. Commercial vehicles did very well, which is linked to economy. Holding companies, again, you see how history repeats, because today also there are talks that holding companies are cheap. So holding companies as a concept at that time also something that I played in. Real estate and real estate linked stocks, because again that is economically linked. So that also did well. But stocks, okay, only some actual companies did well. These are, I'm talking of from stock market perspective. Sugar also did well in that time. See how it repeats. So then I decided to change track somewhere in mid 15, shifted from high PE stocks to these kind of investments, and it was going well till 2016. When demonetization hit. So and markets actually fell a lot. So that created a low base for a rally in small caps in 2017. And also, mind you, 2017 was a global mania. I'm not able to recollect what was those exact parameter factors which influenced the globe, but all world over, economies and stock markets did well, and India also did well. Thankfully, I managed to participate in that, and the portfolio became a decent size. Some thoughts, on how do I think about companies started coming in. For example, one thing that resonated when I heard Ramdev Agarwalji. He looked at value migration at a like a very global level. For example, he talked about how PSU banking was moving to private banking, how scooters were moving to motorbikes, therefore Hero Honda. Then how landlines were moving to mobile phones. So these were the big trends that he was talking. And I was thinking, okay, I don't have the expertise to think at such a high level, but can I apply those same levels at a company side? So value migration at company level started becoming a kind of a thesis for me. 2018 was a negative year. It kind of everything went push, because what happened in US was Trump had these China issues. He started putting restrictions. Then there were talks of global recession. In India, 2018 saw GST implementation issues. We had the ILFS crisis, which happened in mid 2018. So what happened was there was a thought that grew that only the larger companies will be able to navigate these tough periods, and therefore the many of the small and mid caps, they just crashed. So FANG concept was born at that time. Our Ritik, which is coined actually this time, but at that time also it was very concentrated investing. What I saw at that time is that in 2017, it is not that small caps did not give returns, but after they fell, only a very few turned out to be tennis balls, which bounced back. Most of them turned out to be eggs. So I realized that while buying was right, I overstayed in these kind of stocks, similar to how I had overstayed in high quality stocks in 2015, which is when they started underperforming. So selling, the inference was that selling became important. But at the same time, we'll talk of selling later. At the same time, I also saw that even in small caps, there were these companies which continued to do well in spite of the volatility. So, and it was purely backed by earnings and earnings visibility. In 2019, again, there was a recovery aided by global recovery, and all these kind of portfolio related frameworks were evolving. I started meeting managements, attending AGMs, visiting trade fairs, and trying to understand more about the business than about just pure number crunching. And I also realized that while overall over the period of years I had done quite well at a portfolio level, it was very volatile. My returns were very volatile. For example, 2014 and 17 saw huge spikes, whereas 2018 was a negative. 2015 was not so good. So a thought I was always thinking, how do I moderate this? I didn't want to live with these kind of fluctuations in my returns. While visiting management, I played the Dubai card. कि sir, Dubai से कोई मिलने आ रहा है. So people were amenable to meeting. Then what happened is 2019 the recovery was quite good, and actually stocks started becoming very expensive. And luckily, I took a call that because of the expensive valuations, I started holding on to putting fresh money into the market. Till that time, all investments, all my salary savings were going into investments. So salary aya, you keep something aside, move it into investing, put it into it. But in 2019 or 3-4 months towards the end, I held on to that. So luckily, a sort of small cash had got accumulated. And then we know in 2020 what hit. Before we go to that, because I mentioned that I was meeting managements, and I understood the importance of management quality. I just want to spend a couple of minutes on how do we gauge management analysis. Without meeting them, it's not very difficult, but it needs a lot of hard work. For example, the simplest thing is have they walked the talk in the past? So you have to go back in history and read about them through your annual reports and see that what they have said, have they delivered? Do they take steps to increase the longevity of the business, to improve the terminal value of their business? If we can access their trade channels or their employees or their competition, we can ask them, about their opinion of this company and see what they say. How these managements have managed bad cycles or temporary bad phases in the past, and have they come out of it? See, if a company over a period of, say, let's say 10 years has been growing consistently, maintaining profit margins, ensuring relatively healthy return ratios and cash flows, so we can deduce that there is something that they have been doing right. Okay, so that itself is enough to tell you that the management is decent. So there is actually not very strong necessity to meet them, but of course meeting them has benefits. But also we should guard against forming an opinion in one meeting itself, because nowadays managements are coached very well, and they talk the language that investors want to hear. So I just wanted to talk about management analysis. Moving on, when COVID hit, let's rewind a bit. So yeah, next slide. Yeah. I used to always envy those people. For example, Ramesh Damani, he used to always talk about how CMC changed his life, in the dot-com boom. Then how some investors did very well during the infra boom. Now, infra boom was again coming out of the dot-com bubble collapse, right, which was in 2001-2, and then your bull market started. In 2009-10, there were many investors who took advantage of the low prices. For example, in 2016, I visited this Flame Investment Lab for their 5-day session, and one of the participants was Ashish Kacholia. And on he was a participant, student. On public demand, he spent 1 hour talking about his journey, and he spoke how it was shit scary during global financial crisis when everything was falling 20, 30, 50%. And at that time, if you have the guts, the balls, and the money to be able to invest in that, how it helped when it recovered. So I was always a little bit of envious about these and wondering whether I will get a chance. So when COVID hit, I was like, was it my opportunity? Some such similar opportunity. But scary, I'll tell you, it was the shit hit the roof. Okay, the portfolio went down 32% in just a month. So, and you imagine, we have heard of company divisions closing down, sometimes even companies closing down, but countries closing down was unheard of. There was no playbook to this. Okay, people were still in two minds whether it is actually a very serious issue or just a passing flu. People were not relying on the news that was coming out from China, because China was the first affected in February. And there were mass graves and people falling dead on the street. You didn't know what to believe. But when European countries started lockdowns, closing their international borders, India started following. Then it started becoming scary that we have not seen such thing in the past. So PF, went through a big meltdown. Thankfully, what happened at that time is, because I had already formed in my mind uh, the importance of earnings, I started to focus on those companies or sectors which still had visibility of earnings, and I started selling off those where visibility was not there. So pharma became one such areas in which I did panic buying. 40% of my portfolio went into pharma. But I missed IT totally. And funnily, in my bank, IT budget was the first to be cut. When COVID hit. So I used a small wrong example and I extrapolated it, and I said no, IT is not likely to. Whereas actually, IT was such a huge beneficiary of COVID. Because of the big amount of liquidity that was being infused, there was chatter that inflation will shoot through the roof, dollar will become weak, and therefore your metals are likely to do well. Nothing of that sort happened. Dollar remained strong, but the metals worked because of some other reason altogether, which was the China factor. Because China continued to remain open and they continued to import iron ore and manufacture steel and export it. So it was lucky in a way. ITC, funnily, I was looking at something to benefit from unlocking, and ITC was at a 5 or 6% dividend yield, and I didn't want to be fully invested at that time. So I said, okay, let me put something into ITC as a cash equivalent, and luckily it turned out to be a big unlocking beneficiary, and the stock itself also did well. So the idea is sometimes things work without the original intention, and you take it as it comes. One more example I remember, in history in 2013-14 was when I bought iShares. So like I said, no, commercial vehicles had started to do well, Ashok Leyland and all that. So my thesis of buying iShares was their Volvo unit will do well, but actually what did far better was their bike division, which had become a cult by that time. CV did not recover actually so much in terms of financials, but the improvement of the performance of the bike division, Royal Enfield, it just pulled the stock through, giving a multiback. So the idea is that sometimes you get lucky and then you accept humbly that there is a big role of luck. During 2020 and 2021, what I observed was that I'll not say easy, but 2020 there were lockdown beneficiaries like IT, pharma, metals that I spoke. 2021, COVID was coming in waves, so there were geographies which were opening up. So there was demand coming from those sectors which had not performed during 2020, which had seen their earnings disappear during 2020. Those sectors started coming. So the approach was that you take a basket approach. Okay, you get a broad idea right, you throw darts, more or less you're likely to win. Now in this, the benefit of basket approach is that it works well when coming out of a macro downturn. You don't know which specific company is likely to do better or worse, but you know that a sector is likely to benefit. So if a investor is new in the sector and doesn't have in-depth information about specific companies, then going by this kind of basket approach helps a lot. It avoids company specific risk while at the same time being exposed to the sector tailwind, and it gives time to the investor, to me, to study uh, uh, what companies are likely to benefit more than others, while at the same time be exposed to that. While basket did work, but there were some mistakes also. For example, in pharma, what typically worked was the export-oriented API plays. The domestic formulation plays, they did not do so well during that time. I had baskets in textiles, for example, where unlocking. So if somebody remembers that people were stuck at homes in US, and therefore they were renovating their homes. This was during the lockdown phase. So a lot of home textile players benefited from this. But when I extrapolated textiles to include garments and spinners and yarn companies and all, but they did not do immediately well at that time because it was a specific kind of an event which was benefiting a specific subsector within textiles. So I would not say a mistake, but then different baskets worked at different times. Even in in textiles itself, when India started opening up, then garments started doing well. So spinners started doing well. Nitin spinners, Vardhaman or Ambika, they started doing well with a lag. And by that time, the extra earnings that the home textile players had benefited down had started tapering down. So even within a basket or even within a sector, you will have these kind of ups and downs. So it was very good learning in that time. Things were moving very fast, and you had to be a little bit of had to show nimble approach in that time. But kind of broadly, it worked. More worked than so like I said, 2020 was the lockdown beneficiaries, 2021 were the unlock beneficiaries. 2022, towards the end of 2021, what had started happening was I read a book which is Masterclass of by Super Investors, which is a good book to read. It chronicles the journeys of some 10, 12 Indian investors very nicely. One common thread I found out of them is that those investors had a pulse of the market in terms of whether it is going to be a positive market or a negative market. So I started focusing a little bit more on macros. And believe you me, the more you read about macros, the more confusing it becomes. But luckily, again, I zeroed down on two macro analysts. One is Jeffries, Chris Wood, who writes a weekly greed and fear report, which I read till today. And surprise, surprise, Kathy Wood of ARK Investment, who, by the way, is an economist. And she has a monthly podcast. So both of them were starting to tell that there is something not right in the global macro because your inflation was increasing. You remember supply chain issues, Suez Canal got stuck. Before that, China was producing more, so there was shortage of containers. So prices of everything had risen up. So that was feeding into inflation. But at the same time, Europe and US governments were still continuing to infuse liquidity, right? And this time, unlike the global financial crisis, in the GFC, the Fed gave money only to the institutions. It did not reach the common man. So that resulted in a lot of asset inflation, but not consumption inflation or services inflation. Whereas this time, Fed actually gave money, Fed, European Central Bank, they gave money into individual accounts. And that created a lot of surplus liquidity for people like us, not us in those geographies. And they didn't know what to do with it because job losses were not so severe because companies were also incentivized by the governments not to remove people. Okay, maybe they cut their salaries a little bit. At the same time, government was funding these individuals directly. So it was very apparently resulting in inflation at the ground level. And at the same time, the Fed was continuing their QE. So these became very confusing signals for me. So, which is when I changed my approach. It is pertinent to talk about diversification here because it will lead to the next session. So, like I said in my disclaimer, I have nothing against concentration or diversification for or against. I'm just saying that in certain phases it has worked for me. I was always a diversified investor. You could see that I was investing in baskets. So at any time I will have 4 or 5 baskets with about 4 or 5 stocks each. So there'll be a 25-30 kind of a stock portfolio, right? And there are benefits of diversification. For example, during uncertainty, when you don't know what is likely to happen, so you have more companies with smaller positions. They help you hold through drawdowns. If you make any mistake, it will not kill you. And positively speaking, it will expose you to a lot of opportunities, where your ability to learn compounds. So this was always a common thread, right from the beginning of my career, where I was trying to learn and learn and learn as much as I can about companies. And when you have skin in the game, the learning goes to a different level rather than just leaving the stock in your watch list. And also, most important is that when you have so many stocks to study, invest, make mistakes, learn what's working, a lot of behavioral biases tend to get played out actually. So one is theoretically, like you see loss aversion bias or this bias or that bias, whereas when you're actually going through it, that that's a very powerful way to learn more about oneself. Okay, so which is what leads me to the next slide. Who am I? We have heard of so many types of investors. Mr. Shankar Sharma calls himself a hare. You know, then you have some people who are like a sloth. They just buy and hold through forever. There are kangaroos who are hopping. Then we have big investors who sometimes, because of the portfolio size, have become slow. But there are big investors, who are very nimble and very agile also. So who says elephants can't dance? Like they say. So next slide is knowing oneself is a evolutionary process. Okay, so for example, you cannot decide upfront that I am an aggressive investor or I am a conservative investor. You have to go through that phase. You have to try it to see what resonates with you, see what works for you, and it involves a lot of trial and error. And sometimes it can take many years also. If I were to make it a little more personal, I have a day job, right? So compared to a full-time investor, I cannot study so many stocks, and I am some person who cannot buy just based on borrowed conviction. So by the time I study a stock and develop conviction, probably I have already lost it. The stock has already moved 30, 40, 50%. So the universe of stocks which I find automatically gets limited because of this. Okay, so this becomes my limitation. So if I happen to find something that is working for me, then it will be an injustice to myself as an investor if I don't make the most of it. Okay, so this is one of the aspects that also led to concentration, which I will talk about. Also, what happens is, what are our goals? They play a big role. What is our temperament? Uh, what is my purpose? What time frame do I have while investing? All these thoughts is very personal. You have to go through it yourself. You have to put time and energy and effort into this. But the most important part of it is to be true to yourself. Okay, you should actually, while trying out these things, okay, see if it is actually working for you or not. I'll give an example. When I started off, because I wasn't so sure, I continued two SIPs. I respected them. One is Kenneth and Rede in IDFC at that time, and one is Quantum Mutual Fund, Ajit Daya. I respected those two investors, so I continued their SIPs with the intention that at the end of everything, let me see if I did better than them by direct equity investing, or whether uh, you know uh, I would have just let them manage my money and done something else with my time. So luckily, it turned out that I did better than what those were able to do. How do we be true to ourselves? Okay, now during this learning journey, okay, if you look at it, the most important thing is how you have evolved, how you have become better. Now this is very qualitative, very intangible. Okay, unfortunately, the bane of us investors is to know how good we are or how we have improved is your returns in the portfolio. That is a numerical number which will actually show you how you have done, whether you have done better. But don't get too fixated by that. Okay, give yourself flexibility. Always try to think that you are better than what you were yesterday or last year. Don't try to be in the race that every year I have to beat the benchmark. This 1st Jan, 31st December, these are all artificial dates. Unless we are managing people's funds as individual investors, we don't have those restrictions. So why bog ourselves down with that? But having said that, generally over a 3 to 5 year period, we should have done better. Okay, if not, then serious introspection is needed. So this aspect I have seen, generally investors don't follow seriously, and this is very important. We are complicated, yin and yang that I mentioned, they reside in us throughout. So if when I looked at myself, can I be a trader or an investor? Now, when a trader buys a stock, he is looking to sell, whereas when an investor buys a stock, he is looking to hold. Time matters for a trader, whereas actually time doesn't matter so much for an investor. Can we juxtapose these two contradictory thoughts in our mind at the same time, or even at different times? Can you switch between the two? Okay, so this is something that you have to see for yourself. I could not. Okay, I tried all that, and I decided that I was not successful in it. Fundamental investing versus technical. So although I have interest in technical, and Mohit's few programs are excellent in that, but personally, again, like I said, nothing against anybody, but I could not take major decisions based on technicals only. Okay, so I look at it with interest, but not as an actionable input. Then do I want to do momentum investing or sector rotation, which is what happened during COVID time. So yes, I would like to do that, but today's momentum investing is beyond me. For example, quant based momentum investing is something that I cannot do. I'm not fast at it. Okay, so for me, then I have to think few steps ahead in time. Okay, and then play the waiting game. Okay, now if it takes time for your thesis to play out, you're always in doubt. Is it right or is it a mistake? Okay, so these thoughts always keep coming into our mind and complicating our process. There was a good strategy which I tried to adopt, that sometimes based on valuations or sometimes based on technicals, you try and catch the top. Okay, and then the stock falls and you try and buy it back, and so you make a bit of an alpha in that. Now for here also I failed miserably, because whenever I buy a stock, I am looking to hold it for a few years. That's the intention. I'm not saying that always happens, because the thesis might change, but whenever I buy, I'm looking to hold it for a few years. So I don't want to lose my position. So if I feel that, okay, a stock has become overvalued, I may probably sell 25-30% of it. Okay, wanting to hold on to the bulk of it. And I may not catch the top. I may sell 10% down from the top. And then because it is a long-term holding for me, I'm always looking to buy it back. Okay, so I buy back after maybe 10-15% fall, and then after that it may fall another 10-15%, right? So in a 30% move, I have captured 10% of the middle, and that too on 25% of my portfolio, right? So with all this puthal, I realized that it was leading nowhere. Okay, so there was no. It happened in Laurus, it happened in Newland, and I always regretted having done those actions. So I said, okay, this is not again my cup of tea. What I'm trying to say is, I tried to do a lot of things in that time. Okay, and then I zeroed down on my approach, which is what I'm following today. Ishbhai, which is a ostrich approach. So what does an ostrich do? Right? It is oblivious to the surroundings. So the analogy is that I want to focus on companies where I have strong earnings visibility. Okay, and because of macro uncertainty, what I talked about, inflation increasing, interest rates still being reduced, because of those uncertainties, if stock markets tank, okay, and because I know that I am not a person who will be able to take advantage of those ups and downs, okay, so I said, okay, let me just focus on earnings, let me ignore stock prices. So even if a stock falls 20-30%, I should be fine with it as long as my company continues to do well, okay. Now when I looked at my 25-30 companies in this light, I told myself, Vinay Ambekar, it seems that you're not very good at this, because a lot of those companies, I realized, again, because of my limitation, I did not have strong earnings visibility, okay. So I started selling them. For example, I had a steel basket, okay. So I played Tata Steel Partly Paid, which was a leveraged play on Tata Steel. I had Sale, which was like a kachara company, very high debt. But these kind of companies tend to do well, when the cycle turns, because uh, their fixed costs are very high. So any improvement in sales realization goes directly to the bottom. I had Sale. Then I had iron ore plays like Sandur Manganese, Sarda Energy, Godavari Power. Okay, so when I actually sat down and looked at these 5-6 companies, I realized that I did not have the comfort to be able to gauge what the earnings would be. So slowly, all of them got sold out. I held on to Godavari Power because during the time that I studied it, it seemed that the management had learned their lessons of the past. It was a corporate debt restructuring case in the early part of the decade, and that was the only company which actually used the 2020-21 cycle to make themselves debt free. Lot of companies, including Jindal's and JSW and Tata, they talk about deleveraging, but it never really happened in a material way for them. Whereas this was the only company, or one of the very few companies, which cleaned up their balance sheet. So um, I was looking at this company from a structural play and not a cyclical. Okay, so I held on to that. In my textiles basket, for example, uh, none of them, because I could not foresee earnings anyway had started slowing down by 2022 because that initial euphoria had passed and high base had got set. So it was very difficult for companies to be able to grow on top of that high base. So earnings had anyway started to slow down. So my textiles basket got slowed down. Shipping companies, I had GE Shipping, I had Shreyas Shipping, and I had one company called Tiger Logistics. So when the container freight rates shot up, they went up 10, 20 times. The kind of profits that these companies earned and their share price movement reflected that. But then it was so cyclical that as things started normalizing, the container freight rates started crashing down. So again, a question of earnings visibility. So shipping basket. So a lot of things, one by one, it got sold off. It was not immediate, not overnight. It was a period of 1 to 2 quarters, over which all this transition happened. And at the same time, I was thinking, what kind of companies appeal to me. Now, for example, we have heard people say, right, if you get say market cap of a company is 1,000 crore and somebody comes and gives you 1,000 crore, will you buy that company, right? It's a good framework to have. Believe me, it's a useful framework to have because it makes you think deeper about that company. Okay. Another one of my mentor friends, he gave me a framework where he said that imagine your brother or your son or your nephew is wanting to start a business. Will you suggest to him to start this business, for example, Godavari Power, okay, or microfinance? Will you suggest to him to start that business? So these cues help you try to find what companies will appeal to you. Okay, it's not black and white. There's a lot of gray area involved, but it enables thought process to get formed. Okay, when I sold these companies, I have typically been 100% invested. Rarely have I held cash. It has not worked for me less number of times than it has worked for. Okay, so that is another thing I learned about myself, that I cannot hold on to cash. My fingers always start itching that it has to get deployed somewhere. So whenever I sold these companies, they started the fund started getting moved to the companies which I wanted to, hold on. And like I said, because my limitation was in terms of having earnings visibility on only few companies, therefore concentration was a natural evolution of the portfolio. It it did not happen by design. Okay, it was not by intent. It just happened as a process, which automatically meant that allocation in these companies started increasing. Okay, so I'd like to spend a few minutes on how I think about allocation. Like I explained, it is an evolutionary process. Okay, one is why do we get bogged down by these artificial constraints of 10%, 5%, 20%? Okay, what I think of is, if I have a 20% allocation, okay, and let's assume it goes to zero, will it kill me? Okay, of course it will hurt a lot, but will it kill me? Okay, one other thought, of course, is that will I have 20% in something that can go to zero? Okay, ideally I should not, because then that will denote something wrong in my process. Okay, but think about it in this way. Okay, some people think that, okay, if I have 100 as my portfolio today, I will invest 3 into it, at cost, and then I will let it run. Okay, even if it becomes outsized, which is a good thought to have. Okay, but the fallout of this is, say you buy, let's say 3% is still a decent position. Say you buy only 1%. Okay, and then you see something that's working out. Okay, and then within a quarter or two, you have a 10 bagger or a 15 bag. Okay, I will say that there is a flaw in the process, because you have found something which is working. You have found something early. So if you don't increase your allocation to it, then it's a mistake. This was, like a slap on my face, pointed out by one of my, again, mentor friends, when I had invested in Aarti drugs. It was part of my pharma basket. I put a small amount because it was a raw company at that time, not very well proven, although Aarti Group was there. And then that stock just took off, and I had time, okay, to allocate more to it because earnings were coming in that. But I did not. Why? Because I got price anchored. So I read somewhere that having a huge multi-bagger early is actually not a good thing for an investor. So think about this. Okay. Some people also use a hack that, okay, let me take out my principal and let the profits run. Okay. Again, you invert it. If something is working, right, why do you want to disturb it? Why do you want to interrupt compounding? Allocation, again, is something that cannot get decided upfront. For example, I cannot say that I will have 20% in this portfolio. I'm talking of high allocation. Low allocation, you can decide. I want to have 0.5%, 1%, 3%. You can decide that. But at the outset, you cannot decide that I will trim or I will sell if it goes to 15%. Okay. Many people do that. Again, please don't get me wrong. What I'm saying is there are many friends who do this, even individual investors who do this. This is a risk mitigation technique. Okay. And I'm not saying this is right or wrong, but just think of it that you have been lucky enough to find something that is working for you. Okay. Then why do you want to disturb that? If you find a better idea, by all means do it. Okay. But just because of something has gone up a lot, or something has become highly valued, okay, that in itself is not a reason to reduce allocation, as long as you have earnings visibility. Okay, if there is earnings visibility, what will happen? Stock will fall 20-30% in a bad month, no problem. Okay, it may consolidate for maybe 1, 2, 3 quarters, like I'm going through in Shiva Lake, in Arman. For almost 2-3 quarters, these stocks have given no returns. Okay, but I am focused on, can Arman grow from here? Can it be a bigger company in a few years than what it is today? Can Shivalik be a bigger company than what it is today? Right? So I choose to hold on to these stocks. Somebody else who has the ability, who has the temperament, may decide to sell them, move to other stocks which are working. Okay, make their money in that, come back to this, which would be either same level, lower, 20% higher, we don't know. If somebody is able to do these switches, by all means do. Okay, which is what I said. Try out these things and see if you are successful at it. See if it works for you. My position is, having done all this, it didn't work for me. Okay, so my point is, then why should I interrupt something that is working? So then I look, okay, at a portfolio or at a stock level, for example, am I okay with a 25-30% drawdown, right? I want to mention here, booking loss, which is very important. So if a stock is 25-30% down and you want to sell, okay, don't let that percentage of individual position be a constraint to you. Okay, look at it as look at that absolute loss amount as a percentage of the portfolio. If it is 1, 2, 3%, no problem. Okay, feel free to book the loss, because 2-3% in a portfolio can get recovered very easily. So don't get bogged down because of that. So now comes a little confusing part of the discussion, and a few slides remaining. What worked for me through this time is, when in doubt, concentrate. Normally, people, like I mentioned above, people diversify. When they are fearful, or when they have doubts, or when they are unsure. Whereas counterintuitively for me, it it worked in an invert manner. What happened is, you work harder and then you develop more conviction, and therefore you concentrate and your allocation increases, and therefore you have a large position. Now, because you have a large position, you are more watchful of it, therefore you work harder on that position. Okay, and hopefully you have got it right, and therefore conviction keeps on building, right? So these are my friend calls them hooks to be able to hold on to your positions. And then the cycle repeats. Many times we say that when we look at a stock price that has gone up x number of times or x percentage in a very quick time, and it's array miss kiya. Avoid this syndrome. Okay, what you will actually have missed is something not based on stock price. You probably studied it to the extent that you can, but your inference was incorrect. Okay, I'll tell you one example. During COVID, I bought Rajratan wire very early as a part of my auto basket. I played auto basket at that time, so I had bought Rajratan wire, Apollo Tire, FEM Industries, and one more company. Now, you imagine going back in 2020, things were so uncertain, and Rajratan Wire was a micro cap stock, very low liquidity. And for some reason, because it was falling, I was able to build a decent position in that. But I got scared out of it. Suddenly went up, I think 40-50% in a couple of months. And I said, boss, ye to illiquid hai. We don't know what may happen. I've just got lucky. So let me reduce the risk. So I sold that off, but I wanted to be exposed to tire. So I moved that to Apollo. Okay. And Apollo did not do as well. And we know where Rajratan went up, right? So these thoughts, are counterintuitive. This kind of investment, I can say, yaar miss kiya. Okay, just because it was low liquidity, low market cap. But not, today so many SMEs are going up X number of times. If you have not studied them, have you really missed them? Why I am emphasizing on this is because this plays on our mind. Okay, and if you keep telling yourself 5-10 times, ye miss kiya, wo miss kiya, ye miss kiya, then you are like, you probably tend to underestimate or undermine yourself. Okay, so try to avoid this negative mind frame. Yeah. Now, as an investor, what I want to do is invest for a few decades. Okay, at least that's what I want to do at this point of time. I will let the future Vinay Ambekar, deal with that problem. But this is what I want to do. So I want to know early enough in my career what works for me. Okay, Okay, because compounding of knowledge also is very, very critical. So if you have found something that is working for you early and you are able to then keep on improving on it, you are giving it the opportunity to work to your benefit in an exponential manner. So if I were to do, say, trading, for example, okay, it's very difficult for, and my father is 76, he does positional trading. For him, long term is 6 months, by the way. So, but it's very difficult, to do it at scale. Sir. So I want to try and find my mojo as early as possible. And while today this is it, like a concentrated investor, large positions and all that, I'm not saying that this is it. I have arrived. I am still open and flexible in my mind to know that if things change, then I should be open to again going into a diversified. A few thoughts on valuation. So, like I said, earlier I was very numerically uh, inclined. So, you look at financial numbers, P. I used to do DCF, reverse DCF, to find out how much of growth is baked into the price. But they're useful, but it's very difficult to take, for me, to take big judgment calls based on that. For example, why? Because in any valuation, terminal value has the greatest impact, and that is also impacted a lot by your discounting rate, which is your expected returns. You change it by 1 or 2%, your terminal value just shoots through the roof, and then you feel, "Arey, this is cheap." So what I have learned is have a broad idea about see, it's a juxtaposition of growth versus quality, right? So growth in turnover, growth in profits, growth in margins, etc., versus your return metrics, return on equity, return on capital employed, your negative working capital, your cash flow generation ability. So it's a combination of this, which should generate a thought that this is what I want to hold, and then have a rough idea of what PE to be given to it. Okay. While I want to hold on, for a few years, but whenever I buy a stock, it is not as if I'm taking a 10-year view. I take a 2-3 year view and I keep on evaluating. Okay. And always be ready for a 25-30% drawdown, and always be on the lookout that whether your initial thesis has gone wrong or it remains. We have heard a lot of multi-baggers, right? What I want to leave some thoughts is, are we actually taking actions in our portfolio, to be able to give those multi-baggers a chance to play out? Like, for example, we keep interrupting compounding, we keep taking money out, have a portfolio approach. Accept that not all stocks will do well at the same time. But if your portfolio is doing well, then you are bound to have a multi-bagger in the overall scheme of things. Yeah, another common thing we think is stock compounding versus portfolio compounding, right? So eventually one leads into the other. So if you're confident of the earnings, if I am confident of the earnings prospects of my companies, I am willing to hold on the companies through drawdowns, as long as my portfolio, other companies in my portfolio are doing well, right? So it's always a trade-off. We spoke about the most important element of compound interest formula, which is principal. Look to please invest as much as possible, as early as possible into your equity. Another cue is thinking about doubles. Okay, and I'll combine the next 2-3 points in this. So we want a 2x in 3 years, which is a 25-26% compound, right? So, or we want a 10x in 10 years, which is the same thing. So what if it takes 4 years, or what if it takes 12 years? Okay, it's no problem. Just because it is going to delay it by 10-20%, does it really warrant taking some strong action on it and then losing the position? So, for example, Arman at again, no recommendation and all. The standard disclaimers. Just giving the example. Is at 2,300 odd market AUM. Right? Is the scope big enough for Arman to become double, right, from here? 5,000. Can it become 10,000? Right? We have seen companies who have become that. So why not Arman? Wari EPC, for example. can it grow 2 times from here and then a further 2 times? EPC, solar EPC is such a humongous opportunity, and Wari management has the intention to be able to take advantage of it. They have the ability to be able to take advantage. Shivalik, for example, is going through a downturn, but can they grow their turnover 2 times, two times over a few years? So these kind of things keep going on in my mind to be able to hold on to positions. Okay, this is an important aspect. Does portfolio size matter? Okay, and I would agree with Warren Buffett here, because he had said, right, if you give me 10 million, I will be able to grow it much faster than I think 100 million or 1 billion, whatever it is. So even when my portfolio was small, I did a lot of things. It was not like long term investing. I did positional trading, went in and out of stocks, bought other things. So it did work. It helped most importantly in compounding my knowledge. But at the same time, the portfolio also did well. So one should try it. Okay, one should go diversified in the beginning and see what works. Then there may be a phase where, like I am today, where you think that okay, concentration makes more sense now. And maybe concentration will work in the small and mid caps till a certain portfolio size. And if the portfolio size becomes bigger, then you might want to think about diversification at that time, because I want to remain in this small and mid cap space. Okay, so rather than at that time looking at investment in a particular company as a percentage of the portfolio, okay, I should then think of absolute amount that I'm investing in that company. Right? For example, 500 crore market cap company. Does it deserve a 5% portfolio in your portfolio, 5% value amount in your portfolio, allocation in your portfolio, sorry. Or do you think that an absolute amount of 1 or 2 crores, given where the size of the company is justifiable? That these things, will keep coming as we go ahead. What is our edge? Information edge, analytical edge. We have seen, that even now time edge is also slowly slipping away. But what I have seen is analyzing or interpretation edge. So you're given a set of information based on your background or your knowledge about the company, how you interpret it. Whereas somebody who doesn't have that advantage, how he interprets it can be different. Right? So this can be an edge. One thing I keep thinking at my age, I'm 46 now, is with age should you become conservative? The thought is that what has worked till now has brought me where I am. Okay, then why do I want to stop doing it? Right? So these thoughts are something that go on. Asset allocation is something that we keep hearing of. I don't believe in that. In fact, I consider my property investments in pre 2010 also as mistakes. So for me, what seems to work best is equity portfolio and cash. So cash to be able to tide over any unforeseen issues in your lifestyle. Okay, I'm not talking of cash for portfolio. Within the portfolio, you may have a cash position. I'm talking of separate cash. So God forbid, I'm in a day job. So tomorrow, if I lose my job, then I should not change my equity approach just because of this event. So I will maintain a certain cash level for my lifestyle. And as the portfolio grows, you keep growing both of them. So there's like a barbell approach. And finally, it may sound very esoteric, but why not think about generational wealth planning, right? Why not? So that brings me to the end of the presentation. I would credits. This is not my own learning. I have a lot of friend investors, mentors who have helped me through all this, and I owe a lot to them. Remember that compound interest is the most powerful force in the universe, and may the force be with you. Thank you.
Thank you so much for the lovely presentation, Vinay bhai.
Many thanks for bearing with me. And if anybody wants to continue to engage further, I am always open. Ishmoit, you can share my WhatsApp number with anybody who gets in touch with you. I have no issues. In fact, I welcome that. So thank you.
थैंक यू एवरीवन, थैंक यू विनीत सर, थैंक यू सो मच। थैंक यू सो मच फॉर वॉचिंग द वीडियो। डू लेट मी नो कि आपकी इस वीडियो से टॉप 5 की लर्निंग्स क्या थी इन द कमेंट सेक्शन बिलो। एंड हमें अगला इंडस्ट्री एनालिसिस कौन सी इंडस्ट्री पे करना चाहिए, चाहे क्या हम वो टेक्सटाइल पे करें, चाहे हम वो ग्रीन हाइड्रोजन पे ऊपर करें, या फिर हमें जो नेक्स्ट इंडस्ट्री एनालिसिस है ऑयल एंड गैस सेक्टर पे करना चाहिए। सो वो आप जो मेरे को आंसर है कमेंट सेक्शन में बताइए। द इंडस्ट्री विच विल गेट द मैक्सिमम वोट्स, हम उस इंडस्ट्री के ऊपर नेक्स्ट इंडस्ट्री एनालिसिस बनाएंगे। विद दिस आई विल सी यू इन द नेक्स्ट वीडियो। जय हिंद।